Welcome to today's update video called Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR launched in mid-April 2025, just over 7 months ago. We believe SBAR is redefining the structural product landscape by transforming the traditional structured note experience into an innovative ETF solution. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. In today's update video, I will review performance, realized distribution yields, operational benefits, use cases, and current positioning of SBAR. Let's jump into the discussion. As of the end of October 2025, the distribution rate for SBAR was 12.88%. That comes from two sources, the treasuries that we hold in the portfolio, as well as selling barrier options to investors. That creates this income feature of the distribution rate. The SEC yield is 3.76. That will normalize as the Fed continues to cut rates. They cut in September as well as in October. If you look at the total return for SBAR since inception, which was mid-April 2025, the total return investors have enjoyed is 11.31%. And if you analyze that volatility, it's 11%. So been very, very happy with SBAR's performance. We've seen and enjoyed a rising equity market since the April lows, and SBAR continues to chug along and provide nice, consistent returns for investors. Again, 11.3% since inception, and then the annualized yield of that time series, 11%. As far as the use cases are concerned for investors, we see three use cases that investors consistently ask us about. Number one is they're seeking high monthly income. So again, 12.88% has been the realized distribution rate since inception. Every month since launch, we've distributed 28 cents a share. We also see investors looking for an alternative to equities. Equities, for those that have invested in equities a long time, realize that there will be times where there'll be equity drawdowns, whether it's COVID, 2022, other mini corrections in the market. So SBAR provides this contingent drawdown barrier. So as long as the reference indices stay above that 30% barrier, investors can enjoy not a drawdown given the reference indices. So if we look back for the last 35 years, we experienced about 8% of the time using a worse of feature breaking the 30% barrier. So more on that in a moment. And then as for an alternative for bonds. So again, we're going to create an income stream. We have limited duration risk. The only duration risk we have is with the treasuries, and no credit risk because we're not buying individual bonds, and then no counterparty risk because we've received the capital from the counterparty at the beginning of the contract. Relative to structured notes experience, we believe our SBAR provides a superior approach in the sense of continuous liquidity, operational efficiency. So we have investment professionals monitoring any positions that get called, which is a good thing. We want positions to get called. If it gets called, we roll it into a new vintage for the portfolio. We're operating in a 40s Act fund framework, so no bank credit risk, and then it's fully transparent. We provide holdings every day as well as positioning on a weekly basis. And then we're doing this more affordably. We're charging 75 basis points for SBAR's experience, and we believe this is a more enjoyable experience for investors than using structured notes. The way we're enhancing a traditional structured note product with SBAR is two features. Number one, callability. So anywhere from 1 month to 3 months, we've had contracts written in the portfolio. So what that means is at the end of that non-call period, we evaluate the underlying reference indices. If they are up, if all three reference indices are up, then that position contractually automatically gets called. That premium we receive at the beginning is an annualized premium, so that allows us to return or stack premium income return for investors. And then the second way we're enhancing is through a worst of feature. So we look at three underlying reference indices, S&P 500, NASDAQ, and Russell 2000. And we write our contracts over a 1-year time period. And at the end of that time period, we look at the worst performing of those positions. If it's below 30% on a price return basis, then that particular contract would participate in the drawdown. If the worst of is down 28%, then we would not participate in the equity drawdown. So callability and worst of are the ways we're enhancing the yield for investors. This is a position report that we publish weekly on our website. Let me go through the bottom statistics and I'll talk about the chart above. So we currently have 36 auto call positions in the portfolio. We're diversifying that over a 1-year expiration, typically a Friday is what we try to strive for. The distance to the barrier using the data as of the end of October, 31.4 or 30.1, depending on if you're looking at notional weighted or average. Notional weight probably makes the most amount of sense. So what that would mean is the equity markets would have to go down more than 31% for a particular position on average, or the entire portfolio on average, to participate. Again, these are laddered, so we've diversified that risk out. The next statistic is 92% of the portfolio is in auto-call status, which means all three underlying reference indices are above initial value. So we're anticipating to roll a lot of these contracts going forward if equities continue to do well. And then I've got the yields, our distribution rate, as well as the SEC yield. Now, as far as the graph is concerned, the x-axis is the percent notional of each of the 36 contracts. So very diversified positions. And then on the y-axis, this is the distance to breaking the 30% barrier. So if I look at the 0.7 position on the x-axis on the far left, you can see that line. The length of the line shows the best performing, the second best performing, and the worst performing. What really matters in the SBAR's barrier option positioning is the bottom line. That is the reference index that we're going to be using to evaluate whether we've broken the barrier at the end of the contract. Again, these are European knock-in options. It only matters the last day of the contract term structure. And as you can see, on average, we feel like the portfolio is extremely well positioned. Market corrections do happen. The magnitude of a correction of over 30% is extremely rare. Historically, over the last 35 years, it's roughly 8% of the time. So pretty well positioned, very diversified. We like how we're positioned. One other position we do have in the portfolio, it's about 26% out of the money. We have a long put option at 100% of the portfolio's value. We put that position on in September as a way to provide an extra layer of protection in the event, the challenges with government uncertainty and tariffs and all the volatility we've been realizing. We put that on there as a cheap insurance policy for our investors. As far as realized volatility, we're showing here three of those reference indices. We got the S&P 500, NASDAQ, and Russell. We launched with the dashed line in the middle. We launched SBAR right about mid-April. And if you remember, we had the tariff tantrum going on, lots of volatility, big market surge on April 9th of 2025. We got really attractive barrier option yields during that time period because of the tremendous amount of uncertainty. You can see that volatility has dropped dramatically across all three indices. We have had a bit of a pickup in volatility in the last, last 6 weeks or so. It's mostly driven by the government shutdown, the uncertainty with that. So we would expect the option premium to continue to be pretty attractive for investors. I think when we first couple contracts we wrote were around 3.5%. We've been getting closer to 4% as of late. So again, investors buying SBAR, you want the two sources of income, treasuries as well as the barrier options. Volatility is going to drive the barrier option component of the income, and then treasury yields obviously influenced by the Fed's actions. As far as correlations, the reason this matters is as correlations become dispersed like they are as of late, not so much in May, June time period. That time period when you're looking at 3-month pairwise correlations, everything was clustered together. Your premiums aren't quite as attractive. But now that the performance of the underlying indices is starting to disperse a little bit, you're going to get more attractive yields. And the reason for that is because low correlations mean higher probability of something breaking the barrier. In this particular case, it would be the Russell 2000 driving that performance. And as far as the impact of interest rates on SBAR, as I mentioned, there's two drivers of income. There's the treasury option income as well as the selling of barrier options. We did get a rate cut at the end of October. We would expect that portion of the yield to drop a little bit, and we have already started to see that. 25 basis points was cut at the end of October. Again, if we could have increased volatility, that's going to help on the income side of things. So overall, we're pretty pleased with the positioning of the portfolio and look forward to having additional conversations with investors. As far as next steps, so we will be, as I mentioned before, this is a monthly series. Next month, I'll be featuring the portfolio managers to highlight SBAR as well as what we're seeing as far as the insights around the barrier option market. So with that, I thank you for your time and look forward to visiting with you in a few weeks. Thank you.